Welcome to Dreamit Live. We have a great panel of experts with us today who made time out of their day for us, which is greatly appreciated.
Well, let me tell you where not to start, and that's with the Magic Quadrant. We have the world's best mousetrap. See, I have a business model advantage and a pricing advantage.
Let's go back and forth. We're talking about going from secondary school to university.
Hi, I'm Steve Barsh, Managing Partner at Dreamit Ventures. I'm joined today by Mel Shakir, Managing Director of Dreamit Ventures Securetech team. And we would like to welcome you to Dreamit Live. It's great to have a co-host today with Mel. As we go through our topic today, if you strongly agree or disagree or have questions or comments, we're going to have Q&A at the end of this session for about 10 minutes. And we'll be happy to take your questions live. Please make sure to put them in. So welcome to Dreamit Live. And Mel, let's dive in.
All right. Well, today's topic is startups and M&A. Well, how, why, and when startups are acquired. When speaking to startups about their exit strategy, it almost invariably is acquisition. If you look at just 2019, cybersecurity $5 billion USD, more than any category for 5 consecutive years. So to talk about M&A, we have invited 2 cybersecurity heavyweights, Amit Yoran and Mike Viscuso, to share their unique insights on the dynamic and high-stakes process of startup M&A. Well, Amit, he's the chairman and CEO of Tenable. He was previously the president of RSA, where I got to know him and worked for him as director of Netwitness, a company he had founded, which was acquired by RSA. But at RSA, Amit was at the center of mega M&A transactions with EMC and Dell. And prior to that, Amit had founded Riptech, which he sold to Symantec. Well, among his many achievements, another one that really stands out is National Cybersecurity Director for the US Department of Homeland Security. Mike Viscuso. Mike is a co-founder and former CEO of Carbon Black, which merged with Bit9 in 2014 and is now part of VMware. In my current role as MD for Dreamit Securetech, I've been relying more and more on Mike for advice. Amit, Mike, thank you and welcome to Dreamit Live. Did I miss any key points in your short introductions?
Nope, it was great.
Okay. Also, let us know which city you're streaming in from today.
Mike?
Well, I'm streaming in from Philadelphia. I'm actually just down the road from Mel. I was in Boston for about 5 years before moving back to just about where I grew up. My wife and I decided to move back to the area to start our family. We have a beautiful 20-month-old daughter that is running around upstairs right now. So if you hear the pitter-patter, that's my daughter Avery, and we're excited to be in the area, and obviously excited. I'm excited to be here today, and also to help with the Dreamit Cybersecurity Accelerator, which has produced a litany of great early startups in the cybersecurity space, and looking forward to the next cohort now.
All right.
Awesome. I'm coming from Reston, Virginia, Northern Virginia, just a stone's throw from Dulles Airport, which used to be an important part of my life.
And I've seen you there many times. So let's get started with the first topic.
Wait, Mel, where are you? Where are you today?
All right. Well, I'm outside of Philadelphia, as Mike alluded. And Steve, of course, is usually out of Philadelphia, but today he's out of
Park City, Utah today. But
Park City, Utah.
Anyway.
All right. Steve. Okay, let's get started with the first topic. Top reasons M&A deals are done. All right. You have both done small deals and large deals. How does M&A vary based on the stage of a company? Amit, do you want to take that?
Yeah, listen, the obvious criteria is, the size of the company, the larger the momentum, the larger the revenue base, the larger the customer base, the larger the market opportunity, the larger the transaction. And so in many cases, like what you saw with Carbon Black, it was a company with a lot of momentum, a lot of customers, a lot of revenue, and a very large market opportunity. In other cases, you have technologies which have varying degrees of corporate development around them, or in various stages of corporate development. So you may have some very intriguing technology, but doesn't have a mature distribution mechanism around it. And so in many of those cases, you have acquisitions in which acquirers think, hey, I've got a great captive customer base, which aligns with the value proposition of this technology, and we can do an acquisition and bring it to market and rapidly grow grow revenues with it. So you see acquisitions along a wide variety of values, which may be in many cases driven by the size of the market opportunity and the maturity of the company being acquired.
Okay, excellent, Amit. And actually, that was going to be part of my second question as well. So I'm going to turn back to Mike and ask him to answer. What are the top reasons an acquirer will do a deal? Dovetail back on what Amit just said, probably.
Yeah, Amit actually covered it pretty well. But just to take a step back, I mean, a lot of companies are bought and some companies are sold. And so if you're a company that is looking to be bought, it's obvious that you want to be bought, not sold. And the reason that companies are bought, not sold, is because they've added significant value to their customers and their shareholders. And usually that happens over time. So as Amit said, the longer the company's been around, the more value they've been able to accumulate and deliver to their customers, the bigger they are. And so therefore, the bigger the transaction. And so when you look at value, it's not just ARR. It's not just customers. You could be creating a really influential piece of intellectual property where you could have assembled an incredible rock star team. But when the acquirer looks at you and your company, what they're looking at is what value do you have that fits into their strategy. So as they meet with their executive team and they're looking at their strategy for the coming years, they're asking themselves the question of which pieces do we want to build, which pieces do we want to buy, and which pieces do we want to partner. And they're making that decision for any one of those distinctions where they think, hey, this is something that we want to buy. That's where they start surveying the market and saying, hey, who out there has the value that we would like to acquire?
Okay. And so what I'm hearing you say, Mike, is that many of the M&A deals are really driven by corporate strategy, right? Now, of course, there are other things like competitive pressures. There might be some market conditions or trends, that might be driving those deals as well. You also talked about, startups are bought and sold. How does it influence the process if the deal is initiated by a seller?
That's a great question, Mel. And again, right at the top of the decision tree is, are you being bought or are you being sold? And, I think it may go without saying, but I'll say it just to make sure that you don't want to be sold. You want to be bought. And so a company that needs to be sold, it's traditionally viewed at as a fire sale or an acqui-hire. And so you limit the number of potential avenues that you can go because the value is viewed as a little differently than if someone was actively trying to buy you. And so traditionally, when a company is sold, a banker is involved, and a banker might be the first introduction to the acquiring company that this company is on the market and looking for a home. And that process typically signals that this company is being sold versus being bought.
Okay. Amit, you want to add anything to that?
Yeah, and maybe going back to sort of the heart of the discussion at hand, for entrepreneurs looking at exits, thinking about M&A opportunities, I guess, the thing that I would focus on is, focuses on business, right? It's control as an entrepreneur, as a founder, as a CEO of a startup. You want to control your destiny, and controlling your destiny means achieve high growth, but control your burn. Controlling your destiny means turning the company profitable, or if not profitable, at least turn the company so that you're free cash flowing and you're producing cash, not burning cash. And you have under previous rounds of funding or whatever, you have the ability to turn the corner. When you control your destiny, then you have the option of being acquired, but you're not being put in a position where you're forced to sell. As Mike said, that's not where the great outcomes occur. Or you're not being forced into additional funding where you aren't dictating the terms, or you don't have a gun to your head saying you've got to raise the capital or face very, very dire consequences. So control your destiny by focusing on the business, and the right will come.
Well, thank you for that advice. Steve, you want to drive the next topic?
Sure. We'll go next about how can a startup look most attractive. And I appreciate your comments so far that you both made. And before we get into this, I just want to give you a little bit of a preamble from a Dreamit point of view. The number of startups that pitch us, and we ask them, what's your vision? And they'll say, well, my vision is to be acquired by. It's like, that's not a vision. That's an exit strategy, and they seem to get confused. So as we go into this, I just wanted you to think about like what we think about. It's like, don't build a company as a startup. Don't build a company for exit. Build a company to dominate a market, build revenue, build it up really well. And when you do that, the right exit opportunities will come along, but don't build to exit. And I'd love to, if you guys can build on that concept. So how can a startup look most attractive? Like when you're in M&A mode, what's going to look most attractive? You talked about this a little bit. Is it customer growth, revenue growth? Is it technology? So I'm a startup. I want to be attractive when you're at RSA or you're at Tenable or Mike as you move into your next thing. What makes a startup most attractive, and how do I dress myself up so I'm most attractive? Mike, do you want to take it first or either one?
Oh, I'd love to, Steve. I'd love to, honestly. And we're just going to start with where you started, which is, look, build value. Continue to build value for your customers. Continue to build value for your shareholders. And the rest will take care of itself, honestly. Just continue to build value, continue to manage your business, as Amit mentioned, so that you're not forced into a sale, at a time when you don't want to. So continue to build value within your customer base, and the rest will happen. There's always a market for great companies. You never have to worry about, at Carbon Black, when we crossed 250 ARR, we were like, oh, now we're not sure.
250 million in ARR.
Million ARR. Yeah, sorry. Million was implied.
Yes. Okay.
But we had this conversation. Oftentimes, say, hey, we're limiting the number of people that could potentially be interested in us. And our CEO Patrick Morley kept reminding us, no. There's always a buyer for a great company. Mm-hmm. There's always a buyer for a great company. And during our time at Carbon Black, we did acquire 3 different companies, ranging from $1 million to $100 million. And going back to what we were talking about earlier, we had a strategy, and we had a corporate strategy of delivering more value to our customers, delivering better value to our customers. And we were having that build by partner conversation. And we would always look for who was the best. That's where we would start. So if we wanted to move into the cloud, which was a conversation we had at Carbon Black, delivering our endpoint protection from the cloud, we looked at all of the companies and said, who is the best at delivering this from the cloud? And we started there. We always started with the best. And so the best way to be attractive to an acquirer is to be the best. And the best way to be the best is to continue to add value to your customers.
Well, Amit, anything to add to that? How do I look attractive?
Sometimes it's boring when you hear a panel and people agree with one another. But I think Mike hit the nail on the head. You want to be the best. You want to be the best in your market, especially in a field like cybersecurity, where you have enterprise buyers. They test the products. They're highly specialized. They want to make sure that these products are best of breed, and they're smart enough to differentiate, to understand the difference in capability between the number 1, number 2, number 3 players. So follow that vision. Be the absolute best at what you do. And the only thing I would add to it is kind of stay focused. There's a natural desire for startups to say, oh, we could do that, and we could do that, and just we could add that in. And for everything that you do, it takes you one step further away from being the absolute best in that one focused area that is your passion, and where you should be hitting as absolute as you can. And it makes you less attractive to potential acquirers down the road, because if you do a whole bunch of things, acquirers typically want to buy the best at a particular function. Technology. So I'd say remain focused, pursue that vision, and execute. Yeah.
Mm-hmm. Okay. Is there 1 or 2 things just to add to that quickly? What would scare away? I want to look as attractive as possible. Can you think of 1 or 2? I mean, you've done so many in all the different roles you've been in. I mean, what are 1 or 2 things that really would scare away a buyer potentially, if that makes sense?
And I'm going to give a soft answer. Is the thing.
Okay.
The thing that matters perhaps most, but when evaluating a startup, or companies very infrequently make technology purchases. If you're going to spend $10 million, $50 million, $100 million, $800 million, billion, whatever you're going to spend acquiring a company, you're not just acquiring a piece of code that they've already developed. What you really want to do is you want to acquire a passionate entrepreneurial team that can continue to lead, continue to develop, that can enhance the company not just the one they're buying, but also help infuse that sort of startup entrepreneurial adrenaline into acquiring company if they're doing it right. So, when you see and when you're talking to acquirers, it's not just, oh, look at the cool things my technology does. It's that passion and that alignment of culture and vision that I think makes you even more attractive. And I know it's an intangible. The balance sheet will be the balance sheet, the number of customers there are, the bankers will sell all day long. The way you as an entrepreneur have value is you show that passion and that cultural alignment with vision for where that larger acquirer wants to go, and that you can help drive them there.
Okay, great. Let me just so we cut it. I'm going to move into the next section. Mel, are you okay? I was going to move into the next topic. That's okay. So let's move into the next topic, and you touched on it a little bit, but I think it's really important. So a lot of startups are watching, a lot of entrepreneurs are watching. And I think an important thing for them to understand is, where do deals originate, right? Are they because you meet each other at a bar, which doesn't really happen right now for COVID? Is it because there was originally a partnership, a strategic investor? Was there a banker involved? Could you talk about your experience? When you're doing M&A, where do the deals come from?
Yeah, I'll start if you don't mind, Amit.
Sure.
So I think most of the deals that we've been a part of, whether we're on the side of being acquired or we were acquiring, the conversation started with partnership. Almost every single one started with partnership. And through the second and the third and the fourth conversation, you start to really see what the real intention is, because a larger company approaching you for partnership could in fact mean they want to partner. It could also mean that they're looking to buy and they're trying to get up to speed as quickly as possible. Or it could mean that they're looking to build and they're just trying to figure out what to avoid. And so it is a little bit dicey, and I've heard this conversation many times over with the founders that I speak to on a daily basis of like, hey, so-and-so reached out and they want to talk to us about partnering. Should we be worried? And, the answer is maybe. It's tough to give a clear answer on that front, but almost every single buy that I've been in fact, every single buy that I've been part of started with the concept of a partnership, because if a partnership isn't going to work out, there's no way that a marriage is going to work out. So if you can't date, you're not going to do well as married. So every single one started out as a partnership. And then if from the third or fourth conversation, you get to see if it is in fact a partnership, you're going to be dealing a lot with the sales folks. If it is in fact a buy decision, you're going to be dealing a lot with the execs. And if it's a build, you're going to end up seeing a lot of engineering. And so you can kind of see where the corp dev conversation goes in the third or fourth meeting to know which of the three it might be.
Amit, your experiences, and where do most of your deals originate from?
Yeah, no, I think Mike's right. I think most of the deals are complementary. It's a partnership. It's an agreement. A lot of them start in the field. A smart or engaged sales rep, or seeing momentum between sales teams and seeing leverage in the field, and then that makes its way back to, hey, we got to formalize this partnership. We're doing really great things together. I think that's the most natural path, the complementary technology. I'm also part of a small number of deals which are head-to-head takeout transactions. So somebody is competing head-to-head in the field. They look at this startup and say, wow, those guys are moving fast. They're running circles around us from a technology and capability standpoint. If we had that best-of-breed, market-leading technology in the hands of our sales force, our go-to-market army, we could drive some meaningful numbers as opposed to being a number 2, 3, or 4 has-been in a segment of the market. So I would just say that it's less frequent, but those direct head-to-head competitive acquisitions occur too.
Interesting. Okay, I just want to point out 2 quick things from what both of you said. I was going to ask you the question, but I think you already answered it, right? I didn't hear anybody mention because an M&A firm reached out to me. I didn't hear about an investment bank, and I apologize for all investment bankers or M&A firms that might be watching today. This is early stage stuff too, right? This isn't Dell buying it, and then bankers typically get involved, but in early stage, it's what we see too. And I also just wanted to point out quickly, the first company I built after college, we sold to a much bigger company. And like you had said, it's like they came in and they said, wow, if we had your DNA and what you guys are doing, we compete head to head all the time against you. You always win. And oh, by the way, where is everybody? It's like, we're only 12 people. We have 40 people competing against you. It's like, well, it's a world-class team. So it's kind of funny that you had said, I'd seen that personally. Okay, Mel, let's move on to the next topic. Why don't you pick up the next topic? We'll keep going.
Sure, yeah. Let's talk about how do you maximize value, right? We've touched on it a little bit, but if you look at 2019, we saw some companies get huge multiples. Proofpoint paid 120 million for a company that had 1 million in revenue. Palo Alto paid 46.7x for Demisto. VMware paid 8.9x multiple for Carbon Black. So it's a two-part question here. How can a startup maximize value during the M&A process? And what possible magic confluence of stars came together for such big exits? Any one of you wants to go first?
Amit, you want to start?
I guess what I would say is, and Steve, thanks for throwing the bankers under the bus.
Sorry.
You didn't mention the lawyers or the auditors, but
we'll come to the lawyers.
We were coming there, yeah.
We'll get there. We'll get there when the audience turns PG-13. Look, these are not rational transactions by any measure. You can't look at a spreadsheet and say it makes sense to acquire this. I think Mike used the analogy earlier of a girlfriend, a wife, whatever the context was. These are irrational behaviors. And guess what? If you're an entrepreneur, you've already proven you're an irrational actor, because if you looked at the data points, no rational person would ever do a startup, right? Your probability of success is pretty horrific. If you haven't looked at the data, don't. You'll get depressed. But these are not rational decisions. And just like your decision to start a company might not have been entirely rational, you're following your passion, your gut, your vision. A lot of acquisitions happen because the CEO of an acquiring company has this belief that this market is phenomenal and that his or her company can drive phenomenal success through this acquisition. And that's when you sell, and I was saying earlier, it's not just, hey, we've got revenue, we've got customers, we've got the best technology, we have this feature. It's about selling the vision of what you can do against the market opportunity and the acquirer's ability to help you scale, help you execute. And I think when you align those things, you get the best outcome. And by the way, sometimes a banker can help make it a more competitive process. But getting that irrational behavior from a buyer through selling the vision is really how you optimize the outcome.
Okay, so of course the seller has to sell that vision, but the buyer, right? He has to go and sell that vision to his board, because when he says I'm going to pay 46.7x valuation, the board has to start believing that that truly those synergies are so strong that you're going to hit those numbers, right? Because at the end of the day, they have to make a profit, right? It has to make sense for the company. Okay, anything you want to add to that, Mike? We could do a whole episode just on this, I think. But I think there's big needle movers, and then there's small. We already talked about the bankers. Their role is largely on the small needle moving side, so get you an extra buck, get you whatnot. They can introduce stalking horses to help boost that value, but the big rocks are what you just said, Mel, and Amit said earlier, which is you are the best. So there's a premium for the best. There's always a premium for the best because it's hard to be the best. And so if you're the best, you get a premium. And then the second premium really happens with figuring out how that you being the best makes them the best. Because it's not always obvious that a company that is acquired is all of a sudden going to come in and make the new company great at that. And so one of the things that one of the small tidbits of advice that I was going to give here is just, you got to treat this like a huge enterprise deal. You have to have an internal champion who's giving you the feedback of all the board members and who likes it and who doesn't like it and why they like it and why they don't like it, showing you the internal spreadsheet so that you can say, oh no, we think we can drive even more rep productivity because here's why, right? So having that internal champion inside the walls of your acquirer who wants this deal to happen, who would benefit significantly for this deal to happen, and have that person relaying back to you how they're coming up with the value so that you can help them help their team see the really big opportunity in front of them is going to be absolutely paramount. If you do not have an internal champion, and Amit and I both know this
just in terms of getting customers. If you do not have an internal champion, not only are you not going to get max value, but you probably aren't going to get the win at all. And so having that internal champion is the way that I've seen companies get the maximum value, because you're able to translate how you by yourself being the best translates to the acquirer now being the best, and all the benefits that they get associated with that.
Okay, I'd like to just dovetail a little bit on that response as well, and also ask whether startups, when is it optimal for startups to hold out for a better price, right? Is it until at least there are multiple bidders, and or they're super confident about the traction, and just share some insights, right? Anything that you might have experienced personally.
Yeah, I think there's a data-oriented approach here to say, okay, well, given the size of the business now, given the growth trajectory, our expected growth trajectory, what does the revenue base, the profitability, the ARR look like, a year from now, 2 years from now? How does the competitive landscape change? Ultimately, this boils down to, in many cases, a question of confidence and risk tolerance. And so in many cases, you get to a certain point and you say, hey, this is the right, or this is, somebody's paying a premium, because even though we have confidence in the business, somebody's paying a takeout premium, at this point, and it just makes sense from a risk-reward trade-off. Okay.
All right. Yeah. I think, being aware of the competitive buyouts, right? That is an important point that you're making as well. That's the data-driven part of it. Okay. Mike, you wanted to add something?
No, I was just going to, Amit said it spot on when he said, it's how confident are you?
Okay.
When you get to the point where you're not really sure how you're going to justify your multiple, then, okay, maybe it's time, because that opens your brain to, well, I can't see how I can do it myself, but I see how I can do it with Tenable. I don't see how I could do it by myself, but I see how I could do it with this other company. That's when you start saying, okay, hey, look, maybe now's the time to join up with somebody else. Maybe now's the time to really start thinking seriously about those offers. And I'll just sort of put a little bit of a plug for Straight Talk for Startups. They have a whole section on getting liquidity. And I have found with my conversation with founders that a lot of these conversations focus on liquidity more so than confidence. You can always get liquidity. If you need some of your stock off the table, you can always get it. Don't sell your company because you're looking at, oh, I'm on paper worth $20 million and I would die if I lost it. There's always liquidity options. Look at it more in terms of your confidence. When is it that you think, hey, I'm not so sure I can justify the next round of funding. I'm not so sure I can see around the next corner. I'm not so sure I know what to do next, but I have confidence that if I joined up with Tenable, I can do it. That's when you start saying, hey, maybe we should take these things seriously. And again, Straight Talk for Startups, part 5, there's only 5 parts, but Straight Talk for Startups walks through how you might go about that. But again, it all comes down to your confidence in the business.
All right. Steve, let's talk about deal structuring.
Okay. So I'll hit our next topic, deal structuring and explained, right? This is, I have a feeling you guys are going to say it's art, not science. What's the next question? But let's try to dive into some of the details. There's the acquirer side and there's the being acquired side. So in deal structuring, could you both maybe comment, what are the top 2 or 3 most important terms for deal structuring, maybe for either the acquirer or the startup, either way? Amit, you want to go first, or either one, whichever would like to go first?
I'll give you my top 3 criteria for deal structuring, whether it's for a venture transaction, whether it's for an M&A transaction. Criteria 1 is
deal. You hold a little Post-it to your a card to your head. Hold on, number 1. You said. Sorry. Number 1.
Right? Is this clean? Are the terms straightforward? I've seen so many transactions, whether it's M&A or venture funding, get sideways or post-deal regret, buyer's remorse, misalignment of objectives because someone optimized for price versus cleanliness. Keep everything simple, keep everything clean, drive it. Number 2 is deal cleanliness, and number 3 is deal cleanliness for reasons times multiple factors. But so when it comes to earnouts and this and that, it's just I would run from those 10 times out of 10. I'd rather pay a premium or give up on a of a couple of bucks to keep it clean and simple.
Got it. Okay. Mike, thoughts to add to maybe the top 2 or 3 things in deal terms to worry about or the most important for either side of the transaction?
Look, I think Amit is hit the nail on the head in terms of cleanliness. The other thing that I think is more of a subjective, and you already mentioned it's a bit of an art versus a science, but you got to feel like this is a spot that you and the people you've been working with for the past 10 years are going to enjoy. If you can't look at yourself in the mirror, you're going to have regret. That's just all there is to it. One of the hardest things about being in a Amit seat or any one of our seats in a leadership position is that there's a lot of people depending on you, and you're making a decision for a lot of people. And that's if you're any sort of human, it's difficult to sleep at night if you know that you went for the highest price and you committed them all to purgatory. So although it's a bit more subjective, Steve, beyond cleanliness, I mean, you got to really believe. You got to really believe that this is the spot. And if you don't, but others do, that's okay too. But the team, you got to feel like you're doing the team a good service.
Okay. 3, right? It's customers, employees, and shareholders, and the transaction has to really balance success.
I mean, while your mic is hot, so to say, there's something else you mentioned I wanted to bring up, and I have an opinion on it, but I'll just leave it alone. I'd rather hear what you guys have to say. You mentioned about earnout and upfront payment. In deal structuring, again, lots of startups watching, lots of entrepreneurs. Somebody says, hey, I'll pay you $2 million cash up front and $18 million earnout or whatever. What's your experience with upfront payments versus earnouts?
Personally, I'd rather see a time-based value creation. And if you're aligned culturally and you believe in the people you're acquiring, there's some misalignment on price, you create some kind of time-based value. Give them, options, RSUs, what have you, to stick around to build this thing with you going forward in the creation of value. When you start creating an artificially elevated purchase price, or you're trying to shoot that gap between at bid and ask, and you're doing earnout, what happens post-acquisition is you've got a segment of instead of all being part of one team, rowing in complete synchrony, you've got some portion of the team whose objective is to grow this revenue and this product line, come hell or high water, as their sole objective, and a lot of money on the line, and the rest of the company rowing in a slightly different direction. And those gaps exacerbate themselves with pressure and time and everything else. And so what was in your control as a startup, how you're marketing and how your message is spun and how your sales team is comped and how and our integration features prioritized in the roadmap versus your standalone roadmap, those things start becoming incredible points of contention if you aren't really aligned. So I loathe the concept of earnouts and things like that. I'd rather pay a premium, have a structure, and move forward together and execute.
Okay. Mike, thoughts on that? Earnouts versus upfront payment, time-based things, that kind of. And by the way, for those of you watching, if you don't know, Amit said an RSU, restricted stock unit. It's similar to stock option, but different. And when it comes out, it's vests. And when it comes out, it's taxed as ordinary income. Consult your tax advisor. Anyway, Mike, thoughts, earnouts versus upfront payments?
Yeah, I don't want to muddy the water here. Amit nailed it. The friction associated with earnouts. Look, if you're going to do anything worth it, it's going to be 3 years of an earnout, and so much could happen in 3 years. You don't want to be bound by an agreement you made 24 months ago to do this particular thing when clearly the world is different. So Amit's concept of time-based earnouts, if you're going to do an earnout, it's not the worst thing in the world. I don't loathe it as much as Amit does, maybe, but creating milestones makes it really, you're just fraught with error.
Okay.
Yeah, in my experience, right? So I actually went through one of the M&As where there was an earnout. Luckily, things worked out, but we have seen earnouts go sour, right? For the most part, I would say. So I would agree with you 100% on that.
Cool. There was one last thing I want to talk about within this topic of deal structuring and explain. And that last thing is, what's been your experience for our two guests around startup investors, VCs? When you're going through this process, can they help? Can they hurt? Do they get in the way? What role do they play? And I'm going to take my headphones off as you guys answer that question. No, just kidding. Love to hear your thoughts about startup investors. Again, there's lots of startups watching today. How does the VC help, hurt? What's their role? Could either one of you address that or both?
Yeah, I'll start, Amit, and then you can go. So I think investors and VCs tend to focus on it a little bit more than management does. So you don't be surprised if your VC is bringing up, hey, who would a potential M&A target be at the moment? Who would potentially buy you at this moment? They're not losing trust in you. They're just trying to make sure that that you're thinking about it and that you're, at least in the back of your mind, you're focused on it. So don't be surprised if your VC or your investor asks you the question. It's their job to make sure that as a fiduciary in the business that they're that they're making sure that there is some exit opportunity for you and the rest of the shareholders. But in general, investors tend to bring it up a little bit more often than management does. Secondly, if they're even if they're a relatively new investor, they've got plenty of other experiences with other startups, and they may have an experience with Amit at Tenable and say, hey, look, Amit would be a great opportunity for you guys. We did a great deal with him last year, and we highly recommend them as a buyer versus somebody else. We had a deal where they weren't very good. And so they can give you that pattern recognition that they can give you in so many other aspects of your business, but specifically in M&A, that some of the intangibles that maybe a banker might provide ordinarily, the VCs and the investors can give you that subjective point of view that maybe you don't know or wouldn't know unless you'd been through it before.
Just when I thought we were hit rock bottom talking about the auditors, the lawyers, that bring up the VCs. The typical pitch from a VC to a startup is, look, we've done this before. We can help you. We're going to add value. We're going to be in this with you. And having not only my own experiences, but also having sat on the boards of a dozen or more different startups and many friends who have been through the cycle with VCs. VCs aren't going to build your business. You're going to build your business, and the partners aren't going to build your business. You're going to build your business.
Right.
So going in, eyes wide open about what to expect, what you're going to get, what you're not going to get. The real VCs that I think are adding the most value are the ones that cause you to think differently. They're asking you tough questions. They're asking those questions in a way that isn't condescending and insulting, but they're forcing you to think about your business and the landscape and the macro environment and the customer and the market dynamics differently than you're used to thinking. And look, they're not going to know your industry or your products as well as you do, but they're going to question you. And if you have a great relationship, they can cause you to think differently. And that diverse thinking, I think, is incredibly healthy for entrepreneurs and healthy for companies. I would use just sort of final thought is there is a quantum, you sometimes hear vulture capitalists and the evils of VC, and there's a real delta between two different factors. One is, are you dealing with, what is the quality of the VC? There's a lot of JV players out there which can be quite harmful to entrepreneurs and companies. They're following a playbook they don't really understand, and so on and so forth. And so I think that really matters. And the second is how well aligned you are with the VC. It's almost like getting acquired. Do you really want to be in bed with this person? Do you view through the world through the same lens? Because you're going to have thorny conversations, and they may be about, we need to raise more money, we need to burn less money, we need to burn more. We want to hire this guy, we want to fire this guy, we want to bring in a new CEO, we want to do all these things. And some of those conversations are going to get thorny. And making sure that you really believe, trust, and can have constructive and even healthy arguments and disagreements with your VC is incredibly important. So do your homework and your background checks, not just with their references, but with other entrepreneurs you may know where they've invested and those companies have been successful, and how have they behaved when companies went sideways or went through tough times. And it's just really, really helpful for an entrepreneur to go in eyes wide open.
Two quick comments on that, right? You earn your stripes when the chips are down, right? That's where it's and you're right to talk with an investor or startups that have gotten money from an investor. What happened when things went sideways? The one other thing I just wanted to add in deal structuring and when a VC is involved that I found it's when the entrepreneur finally understands the capital stack piece of crap that they've put together over 5 or 7 years. Well, we did a note and a note followed by a safe with a cap safe with a bridge round with the next Series A that had these preferences, and then there was participating preferred. And then when they go to try to exit, they're like, wait a second, there's a $70 million transaction, and I, as the entrepreneur, am walking away with $800,000. How did that happen? And VCs are like going to protect their position. And I think it's really important. It's one of the things that Dreamit does, all the managing directors, all of us, when we have our entrepreneurs going through and they're raising money, and they come up with kind of crazy amounts they're going to raise. We're like, wait, do you understand what's going to happen if you don't structure this correctly eventually? So it's really important, and you don't want to get that education when you're signing an M&A deal. You want to get it earlier on. So anyway, let me go on to the next topic. I want to just be careful on time. The next topic I'll take, and then I'm going to hand it back to Mel. But the next topic is M&A tricks and traps. Just in general, maybe each one of you, besides having a clean deal, got that one from me, but what are the top 2 to 3 mistakes that either startups or acquirers make, or tricks or traps from either side? It could be a positive or negative. I mean, I can give you a layup one. Maybe you could talk about like the time. You're working on a deal and it's 3 months in the deal, 6, those kind of things. Big tricks and traps that either side of the transaction that startups should really pay attention to, maybe acquirers. Mike, do you want to go first?
Yeah, I might not actually answer the direct question you're asking, okay, but I would like to double down on what you said earlier, which is sure. I think one of the biggest traps that startups fall into in an M&A is just not having the right experience around the table. So if it's your first time going through an M&A, it's like the first time going through a financing event. You have to have the right people around the table. That might be an investor that you really have built a great relationship with. It might be your general counsel that you built a great relationship with. It might be your independent director, whatever the case may be. Do not go through an M&A transaction without having the right experience around the table. They have to have had previous M&A on both sides of the table. Otherwise, I can guarantee you're going to have way more answers on the tricks and traps than I have right now, because it's going to happen. It's going to happen to you. And I think, just one of the things that I've always just kind of found a little interesting, and I can't say we didn't do the same thing at Carbon Black, but when acquiring another company, the first 2 acquisitions we did, we focused a lot on ourselves and how would this benefit us, and what are you willing to give us? How are we going to benefit from this thing? And then in the third transaction, what we did was we scrapped that. And we said, hey, look, that didn't work as well as we thought. And in the third transaction, which ended up being our biggest one, we focused most on the company we were buying. Who were the people that were going to take on leadership roles, that were going to report to the CEO, that we wanted to influence us in a big, big way? Were they the right people? And instead of focusing on this acquisition as just a black box company, we focused on the individual people and what role and responsibility did we want each of them to have, and what level of influence did we need them to have in order to make this transaction a success. And it went way better. I remember going to the company when we announced that we were going to acquire and saying, hey, look, you guys have 60 people in engineering. By the end of next month, you're going to have 180. And wow. And they were very skeptical, and we were very certain like this was the direction we wanted to go as a company, and the same leadership that they had, we're going to now inherit 2 times as many people. And so I think one of the trips and traps that acquirers fall into is viewing the acquired company as a black box entity that all of a sudden they can like plug and play like a Lego or something. It's not like that. You're not going to get the best benefit out of it. And so if you're on the side of the transaction where you're being acquired and you're not hearing how your leadership is going to assume leadership roles in the new company, that might be something that could cause you a little caution.
Okay. Amit, to add tricks and traps, maybe 2 or 3 big tricks or traps you've seen on either side that startups should really pay attention to or acquirers?
I think Mike's point is a great one, and got lots of war stories here. We can have a beer and tell jokes about.
Okay.
Maybe after the show. The only thing I would maybe add is sort of the mindset from an entrepreneur about what is what is the sort of transaction itself, and then what are my expectations from life and from an employment reward perspective post-transaction. And sometimes you get egos, you get emotions, and you just have to be very transparent and self-aware about what you're looking for, throughout that continuum. What is for the transaction, and then what am I really looking for going forward? And that's true of an entrepreneur as well as, of course, acquiring company.
Okay, sounds good. Let me hand it back to Mel. We'll move into the next topic. Appreciate your thoughts on tricks and traps. Mel, can you? I know you had one other thing you wanted to talk about.
Absolutely, and this is my favorite topic, right? Top cybersecurity M&A trends. Well, my background's in product. I know you guys love product. So 2019, right? It was the year for endpoint security. Clear trend. We saw Carbon Black, Sophos, Symantec, and not to forget CrowdStrike IPO for $6.7 billion. BlackBerry acquired Cylance just late 2018 for 1.4. I think are going to be the top cybersecurity M&A trends for 2020 and 2021. And what are the key drivers? So, Amit, I know that every year in late December, you kind of put out your predictions. So this is your chance to kind of revise your predictions if you need to.
Or a new prediction.
The predictions are always right. They just aren't necessarily right for the year they're predicting. I think right now the COVID impact on technology is sort of partially understood. I think everybody recognizes the work from home. Everybody recognizes the digital transformation, the shift to cloud. I think it's a much more profound shift than we really give it credit for. There's still these questions about return to work, return to office, return to normal. I think those types of things are going to be, I would say, temporary, but our behavior and our expectations of technology will have changed. So yes, maybe there will be more in-office or some hybrid that will be for at least for years to come, if not sort of permanent change. So I think, to me, the most important thing is understand how technology landscapes are shifting, whether it's work from home, digital transformation, but also, what are the longer term trends with respect to SaaS, cloud, thin compute platforms, and how do all these things sort of fit together over an extended period of time? So it's kind of a loosey answer, but these are non-trivial shifts that have just accelerated, tenfold. Okay.
Mike, you want to take the same question?
Oh, no, I don't know, man. honestly, I was joking with
We'll give you a chance to revise it towards the end of the year. How's that?
Yeah, honestly, I was joking with a buddy of mine that we were saying, hey, for 10 years, we've been calling for consolidation. For 10 years, every year, we're like, this is going to be it. And now we have a prime moment where COVID is affecting everything. And we basically said, hey, is now the time that we're going to see the consolidation that we've been forecasting for a decade? And I don't know. I literally have no idea. But so I guess we'll see. But it seems like consolidation is got to happen. But over the course of the 10 years, we've seen nothing but fragmentation. So I guess don't follow my stock advice.
All right. I'm going to ask one last question. And then we're going to go to Q&A if you want to reserve a little bit of time for for the audience as well. The impact of giant cloud public providers like Microsoft, Amazon, Google, right? And they started off building hooks, for security, and again I'm referring to security, and it drove a lot of innovation. But since then they've developed products and acquired companies. So what I'm thinking is Azure Sentinel, AWS Security Hub, AWS Guard Duty, Inspector, Google Chronicle. What do you think is going to be their impact on innovation? Any thoughts? Any one of you?
Well, listen, for sure, these large infrastructure providers are going to have a tremendous impact on how security is performed going forward. But security is always changing and evolving. And if you look back 15 years or more. Firewalls were a key security function. Firewalls are almost no longer considered a security function. They're now run by network operations and infrastructure teams. And security activities are much more on the bleeding edge. So I think a lot of the things that you can expect to see out of providers, in my estimation, are going to be more sort of core infrastructure types of things. So great that they're putting more hooks into it. It's like Microsoft saying they're building security products. Like, good luck with that. They'll build security products. They'll improve the security of their products, but there's plenty of space. There's plenty of gap. It continues to move the needle on what our expectations are of the security industry, because even with the improvements that Microsoft have made, it's there's still they leave a lot to be desired. I guess we could sort of leave it at that. So the infrastructure providers will have impact. They'll continue to mature things at more operations scalability standpoint, but I think there will remain lots of space for the leading edge companies to deliver best of breed capability and help with meaningful gaps in security.
Yeah. All right. What I'm hearing is that startups have nothing to be afraid about. There's going to be plenty of innovation. All right. So with that, I think I'm just watching the clock. Let's move off to the final set of Q&A. We covered a lot of ground. Thank you again so much for your time. Steve, do you want to take us through the questions?
Sure. Happy to. So we have a bunch of questions, and as people are listening in, if you want to ask other questions, please put it if you're watching on YouTube or LinkedIn, just feel free to put your question right in as a comment, and we'll take it. And I'm going to bring up the first question here. It's not a daily double, an audio daily W. It says, is it ever safe to sell to a direct competitor? Either one of you could take it. Direct competitor approaches you, tenuous situation. Do you guys have thoughts? Is it safe? So again, these are audience questions. M&A, ever safe to sell to a direct competitor?
I think
Mike?
It depends on what your definition of safe is. There's an implication there that I'm reading into that maybe isn't supposed to be. But I think, as Amit already mentioned, there's a lot of times where a larger company will buy a direct competitor because they're beating them in the field everywhere, and they want to figure out how to bring that team and that technology in-house and that thought process in-house, and it might make a lot of sense to join forces. I know when Carbon Black and Bit9 merged in 2014, Patrick and I both have a really funny story about how Patrick called me and said, "Hey, we should get together," and I was like, "No," like we should have dinner sometime. No, and so I think it's safe to be skeptical of a direct competitor reaching out to you saying, "Hey, what about partnering?" But the Carbon Black Bit9 merger actually worked out really well, not just for Bit9, but Carbon Black and our customers, the market. We did really well with that. A lot of people benefited from it, and we were on a collision course. There's no doubt about it. And so I think it's, from my experience, especially in that transaction, it was absolutely safe to sell to a direct competitor. But I was very skeptical in the initial conversations of what was the true intention of the call.
Okay. Amit?
Yeah, no, I think that's exactly right. I think the natural entrepreneurial reaction and to be skeptical, and I think that's healthy. At Tenable, we acquired Indigi, which was an OT security company. We had an industrial security product in the market, so we were a direct competitor. We looked at what they were doing and said, wow, this is light years ahead of what we've got organically, and the two can be very complementary. At RipTech, we were acquired by Symantec. They had a directly competitive managed security service offering, and go on. So it's counterintuitive. Be careful doing it, but there are lots and lots of examples where you have competitive takeouts.
Okay, let me move into the next question. If you guys have, it looks like we have about 10 minutes of questions left. If you can stay on with us, if one has to drop off, we'll keep going. Here's your next question. Is there any such thing as the best time to exit? Thoughts? I think it's a tough question, but any such thing as the best time to exit?
Well, I'll just plug the Straight Talk for Startups again, just real quick. The book implies that.
Okay, I'm just going to say book, reference, website. We'll post it in the comments for sure. There it is. Okay, Straight Talk for Startups. Awesome.
By the way, the reason I'm referencing the book is because I thought they did a good job of describing what the local maximum of your business is, and when you see your local maximum. I tried to frame it as, and Amit tried to frame it as, when you're not sure what to do with the business next. When you have a local maximum, implication would be, hey, maybe it is a good time to sell. The tough part, obviously, is figuring out when you're at a local maximum.
Right.
And so I think it's easy to say, yeah, when you're at a local maximum, maybe you should think about selling. But I think it's way harder to know when that local maximum is. And if you listen to a bunch of early stage VCs, current mindset on this is you should never sell. Because the power law returns are such that the big guys are just going to keep getting bigger. And if you're on something hot and you can keep growing it, keep growing it. But this is a way more nuanced question than I think either Amit or I or you, Steve, or Mel could ever answer on this thing. But it is really tough to tell when the best time is to exit until many, many years later.
Okay. Amit, any quick thoughts on it?
No.
Leave it alone. Okay, let's keep going. All right, next question as we tear through these. How can a founder protect against being removed post-acquisition? And I guess removed where, do they have an employment agreement or, you're into it. Any thoughts? How can a founder protect against being removed post-acquisition?
I guess I would just say, look, when you're going in as part of any transaction, you should have incredible clarity through things like a contractual, relationship, a key employment agreement, something like that will tell you and outline the various scenarios, whether it's termination or sort of constructive termination where they, demote you but don't fire you or any of these sorts of things. So, one is make sure you've got alignment of vision, ask the tough questions, have clarity going into the conversation or going into the relationship so that you know what to expect. And then have the contractual understanding of how things will play out in various. But once they buy your company, depending on earnouts and payouts and all those sorts of things, once they buy your company, they bought it's theirs, not yours.
Okay.
Bingo.
Mike, thoughts?
Bingo. Once they bought the company, it's theirs, not yours. And quite frankly, if they're trying to remove you, you might not want to be there. It might not be the environment that you want to be in. So I agree with everything Amit said, which is any good transaction lawyer will make sure that you're well taken care of. I will just throw a little bit of a nugget out there to anybody who's in the process now. It's way easier to talk about yourself as the founder last because then you've got the emotional commitment to do the deal, so you can get a little bit more, so to speak, for yourself. Don't talk about yourself first. It comes off wrong and you won't get the best deal.
Okay, let's move through 3 more questions and then we'll wrap up. So next question came in. Any red flags to be aware of with respect to paid M&A advisors, investment bankers, and lawyers? Wow, we got them. We could just add VCs into that. We'd have everybody. Okay, any red flags to be aware of if you have paid M&A advisors, investment bankers, lawyers? Is our next question.
I think the biggest red flag is just, look, as soon as you engage a M&A advisor or an investment banker and they're the ones going out and saying, hey, I'm engaged with this company, you have the for sale sign on your door. And it's tough to get rid of that stigma. And everyone knows that the signal is that it's a fire sale. And so don't do it unless you're at that point. The only other time to do it is when you have an LOI in hand that you're seriously considering and you have a fiduciary duty to other stakeholders to make sure it's the best deal. But that's a totally different conversation in the sense of your M&A advisor or investment banker is going out and saying, hey, look, we have an offer and the company has retained us to make sure that this is the best offer and best place for the company. And that's a totally different conversation. So again, going back to literally the first thing we talked about, which is you want your company to be bought, not sold. If you do not have an LOI in hand from a different company or anticipate one in the next, we're talking 36, 72 hours, engaging an M&A advisor or an investment banker sends a signal that it's a fire sale.
Okay, Amit?
I agree, and I think that's it. It's companies are bought or sold. I wouldn't engage with one or contract with one ahead of time because you don't want to be out there selling your company. The flip side is I would invest in building a couple of relationships, right? You want to court plenty, you want to understand who the different advisors are, what their relationships look like, how they behave, see how they perform, look at their track records. Because when you do get an LOI, you do want to engage with an advisor. In most instances, you can optimize your outcome by doing it. That's what they do. You just have to have the relationship and not scramble 5 hours before you're expecting to sign an LOI. So, let them understand the business, understand you, get to know you and the team and how you think about the business and the market and the opportunity and who else other potential fits might be, so they know who else to approach from it, to make the deal competitive. And so they add value, but build the relationship long ahead of any transaction.
And Amit, you're not, just give me 1 second, Steve.
Yeah.
Amit, you didn't say this out loud, but just, my understanding is that during that courting period, that relationship period, you're not actually paying them.
Oh, yeah.
So you would never retain them to build the relationship with them, just to be abundantly clear. Amit is saying, hey, you can go out and let an investment banker or an M&A advisor be around the company for years without paying them, but build that relationship. It's when you engage with them and start paying them is when you have another offer on the table, or unfortunately, you're hanging the for sale sign up front.
Okay, great. 2 more questions. I know we're cutting really short on time here. Next question is from Adwait, who asked it over YouTube. Question for you guys. What are the signals and clues that the founding team should know if they're at a juncture where they should make a decision, if they should continue to own and build, or sell and exit? And I think this might be similar to that local maximum. Mike, if you want to start, Mike, hold up the book again. How do you know? I guess this is a
summary from the previous portions of the conversation. I think there's a conceptual academic local maximum, but really, I think the bigger thing that you're going to know is in your gut when you say, hey, I'm not so sure that I can justify another fundraise or justify my current valuation. But if you change this about the business, if I join up with Tenable, if I join up with somebody else, if I acquire this other company that's struggling, or whatever the case may be, if some other inorganic thing changes in my business, I can see a much bigger future. I think that's probably the right time that you should start saying, hey, okay, let's start figuring out who that person is and whether they're interested. And again, the book Straight Talk for Startups helps in that capacity. Like, okay, now you've made the decision that you want to join up with somebody else. How do you go and get their attention without them thinking that you're for fire sale?
Okay, sounds good. Okay, last question we're going to bring up, and it's not exactly an M&A question, but we can attack it very quickly, from Jonathan, who asked it over YouTube. We're launching a service in the next week. We've been lucky to land huge partnerships and big leads that can give us traction early. What tips do you have to truly use this early wave in the best way? You guys have thoughts? We can add too, but how do you use this early traction and big leads in the best possible way as they're just launching their product?
Well, I'll just real quick add my little 2 cents, and then Amit can add his nuggets of wisdom. If it's a huge partnership, just know that the partnership is only going to be as good as the level of effort you put to it. So just by inking a deal with a service provider or a value-added reseller or an OEM partner, you have to have someone on your side that is accountable for those results. The road is there. Now you got to drive down it. And I've seen lots of partnerships not do as well as anyone expected them to do because we just didn't have a dedicated resource to it. So I would be thinking, just based off of what I know right now, hey, who is my dedicated resource for each one of these partners? Because it's only going to be as good as the level of effort you put into it.
Okay, Amit?
No, I agree. I think that's right. If it's partnerships, it's the level of effort you put into it. How well aligned are you? How much investment are you putting in to create leverage in the partnership? And that's a continuous lift. It's not a one-time launch and we're done. It'll all fall into place. And that's true during various stages of corporate development, from your early customers and design partners all the way through scale and go-to-market partners. A lot of these is all about putting the appropriate level of investment into the right relationship to guide your development as a company.
Okay, terrific. That is our last question. So let's wrap it up. Mel and I spent a lot of time. We really appreciate your time just prepping for this and getting ready for this talk today. We find that so many startups know so little about M&A, understand so little about their process. And we so greatly appreciate that both of you who've been through this so many times, sharing your knowledge, wisdom around M&A, startup transactions, acquirers. It was really, really helpful. We appreciate what you shared. Mel, it's been terrific to co-host a Dreamit Live with you. We're going to do this more and more with co-hosts. So let me just wrap it up. Thank you to all of our guests. Thank you to Mel for co-hosting today, for Amit and Mike for streaming in today. I know these are really tricky times and both of you are extremely busy. For those of you still watching, we really appreciate you watching. For future Dreamit Live episodes or to see past episodes, please go to dreamit.com/live. Check out the Dreamit Dose. We're cranking them out about once a week. They're these extremely short 5 to 7 minute YouTube videos on highly pragmatic techniques that we find mistakes that startups make again and again. So check out the Dreamit Dose. Thanks, Mel. Thanks for everybody for watching. Again, Mike and Amit, thank you so much for joining us today, and we appreciate everyone's time. Have a great day and stay well.
Thank you.
Thank you.
Good luck, everyone.